So everybody, welcome back to the Learn to Trade Smart Money Concept series. So this episode is episode 4 within this series, and pretty much we lead on from the last episode that I made where we discussed pretty much an introduction to smart money, what smart money is, who the smart money operators are, and also tied that all into supply and demand balance is, what that means in terms of the market's movements, the aggression of the market, so on and so forth, pretty much just how supply and demand controls the market. So we'll lead in onto that, and we're going to move on to points of interest. Now, we started to slightly touch on that at the end of the last episode where I was discussing how obviously all swing points in the market are representing areas where the smart money operators hold positions. That's because in order for a market to reverse, therefore creating a swing point, they would have had to undergo a certain consolidation period to manipulate the market, to introduce enough positions to cause the reversal. And what we're going to do is we're going to walk through how they manipulate the supply and demand balance to make this happen. So what happens, and there's pretty much, it's hard to say every time, but we should look at it as every time. So let's just say arguably every single time we see a reversal in the market, there is reasoning behind it. Okay. Now looking on our screen here, we see that I'm on a 3-month time frame on Australian dollar, US dollar. Now, the reversal that's happened here, so the last major swing point in the market, has happened for a reason. Now, can any of you tell me what that is? If so, just think in your heads, and then I will reveal it. So let's just remember where in the market hold relevance. Now, this is something we were talking in the last episode about institutional footprints and order mitigation. So we know that in certain regions of the market, there are positions left over by the smart money operators which represent footprints or unmitigated orders, which hold key relevance within structure and are a key part of what we use to analyze and predict a market. So the main concept of these within bearishness, in order to identify a supply zone, we are looking for a region of a buy to sell or a buy to sell candle. Now what we see is that this region right here perfectly represents a buy to sell region, and therefore we see that now, oh well, price has reversed right here in this region. Why? Well, that's because we have just tapped into a point of interest, a supply zone. But then let's talk through why we see a reversal at these zones, why it can represent a level that introduces supply, hence why it is called a supply zone. So what we know is that in order for this buy to sell happen, what has happened inside of here is that the smart money operators or the institutions have opened a buy position right at that swing low. They've opened a buy position large enough, as we see by the volume of that candle. The volume of the candle represents the length of the candle itself in comparison as well to the length of the body. We see that the length of that candle is very long, and the body alongside that is also very long with minimal wick. So we know that that is a high volume candle. High volume is always a representation of institutional control because the institutions are the only things that are capable of introducing volume into the market. So we know that a buy position has been opened here by the institutions because we know as a simple fact the market has shot up. In order for the market to move upwards in the first place, the institutions open a position at that swing low point where they open buy positions in order to introduce enough demand to cause that move up. The fact that we've had the move up being of such high volume is a great indication of institutional control. So that's one sign that the institutions are present in this region. We see as we get to the top, that's obviously when volume begins to diminish because the smart money operators are therefore bringing price to a consolidation phase so that they can then reverse the market, create a swing high point and open sell positions from that region, which they of course profited on longer term. But because prices come back lower with such high volume, the idea being that inside of this region, the second that sell position's executed, it pushes price down so fast with such high volume that this buy position cannot be taken out or cannot be closed. Therefore, as price continues to move lower, this buy position is still open, running in a loss. Now, another sign of a point of interest being a point of interest and this being a valid footprint is, let's walk through that again. We know that at the swing low, a buy position has to be opened. The fact that we've seen high volume after that swing low being created is a good first sign of institutional control. Then after we create the swing high, The move lower we see in this case has also been a very high volume. We see that the second we move away, we move down extremely quickly. There's no pullbacks, no real structure returning in that region. And even in the candles themselves, it's very long-bodied, long candles, which represent very high volume bearish structure within this move down. So this also ties onto something called market inefficiencies. Now, a market inefficiency represents a region in the market where there is inefficient price action. What that means, and a great representation of that, is the structure created after we got that swing high point all the way down. Now, what's happening in an inefficient market is that all of the footprints and orders that are being created are not being mitigated. Because the move lower has come down so fast, this right here is a representation of an inefficient market or inefficient structure, because every single one of these buy to sell orders remains open in the market. We compare that to a different form of structure, which would be slightly less aggressive and efficient structure. We see that what's happening inside of efficient structure is that price is returning to that buy to sell region, therefore mitigating the orders out every single time we create that correctional wave. Therefore, that structure is more efficient because there is less to no unmitigated orders left over in the creation of that structure. So what it means when we have market inefficiencies or inefficient structure is that we can assume that price is going to be magnetized to that area, because if price action and structure in that region was so inefficient, there's going to be many lower time frame orders left over within that region that price will want to mitigate and therefore target as a point of interest. Now, what we need to do in order to look for market inefficiencies is a region where we have high volume with no wick and no opposing structure returning. So we see that from the bottom wick of that candle, let's draw a line, to the top wick of this candle represents a level of inefficiency. We see that price perfectly came to tap into that inefficiency also. The reason why this is inefficiency is because we know between this level there is no structure and no wicks that return within that region, which is a representation that right inside of that region, the structure looks a little something like this. So the bottom wick there, up, obviously represents a small move up, then a heavy move down, small move back up. And that is pretty much what this structure is representing. And our lines are representing that region inside of there, where we see that there is no structure between those lines where we've seen pullbacks, where we've seen wicks created. What that means is that that region we've identified as a market inefficiency has inefficient structure, and therefore is extremely likely that there is lower time frame orders left over in that region that need mitigating out. Now, there is a rule when it comes to identifying market inefficiencies. When we're looking at a bearish inefficiency, like we are in that case, first thing we do is we identify 3 consecutive candles. In this case, our 3 consecutive candles, if we just zoom in on that, represent 1, 2, and 3. In order to identify a market inefficiency, we look at the bottom wick of the first candle. So that is the first candle. We've taken the bottom wick. And then we also identify the top wick of the third candle. So that is the third candle. We've identified the top wick. The area in between that represents market inefficiency. And we want that candle in between ideally to be a very high volume, so a long candle with a little to no wick. So this is pretty much a perfect example of a market inefficiency. Another example of that, we could take 1, 2, 3. We take the bottom wick of the first candle, which would just be the bottom of that candle. And then the top wick of the 1, 2, third candle, so that would be there. We see that the region in between is representing market inefficiency. However, obviously in the first example here, the inefficiency is much more vast than any other we could potentially identify within the market. So, back to the point we were making. Why is this an area of supply? Why is it relevant? Now, we've touched over market inefficiencies, and that is a point of interest in itself. A market inefficiency acts as a point of interest. Why? Because of what we've just walked through. A market inefficiency represents a region in the market where there are unmitigated orders on the lower time frames, which acts as a point of interest for us because we know it holds relevance to the smart money operators. That is why it acts as interest to us. However, we never just use market inefficiencies alone. We always want to try and pair supply or demand zones alongside market inefficiencies, like we did in this example where we've identified a buy to sell region, so a supply zone, and then we've identified alongside that we have market inefficiency, which is a representation to us that there is volume in this region. There's been volume introduced on that move down. We know that because there's inefficient structure, there's more reason for price to return to that. So A, it is a sign of institutional control, and B, it is more of a reason for price to have to return to that region, and therefore more of a reason that our analysis and bias is correct. But now let's actually try and reference this to the supply and demand balance, because I know that that is something that a lot of people struggle with, is understanding the supply and demand balance. So let's talk about how order mitigation and supply and demand zones tie into supply and demand. So if you remember correctly, I was saying if we took the balancing scales, ignore the awful drawing that you're about to see here. On the left, we have supply. On the right, we have demand. Now, as I was saying, it's a constant battle of how many lots of selling power representing supply compared to how many lots of buying power representing demand. Now, let's just say, for example, as we tap, and let's just reference this, as we tap this zone and we enter a ranging period, what's happening is that we enter a region where supply and demand is extremely similar. So let's say supply is, just for example, 1,000 lots. I'm sure the number of lots in the market at any given time is much more vast than that, but we're going to use that simply as an example. So let's just say both of these are representing 1,000 lots. The second that price taps this zone, what we have to understand is that, as I stated, the institutions, when they open a position, they're opening a position that is such a large lot size that it holds a lot of relevance within the supply and demand balance, because their positions hold such a high portion or high percentage of any current supply and demand that is in any market. So what that means is that when we have a buy to sell region, like we do in this case, this buy to sell region has buy positions that are contributing to the current level of demand that is in the market. Now, of course, when we bring price to and tap this supply zone, we are mitigating the order. What that means is that the buy position that's open here gets closed once we tap that zone. What that means is that we close a position, we remove lots of buying power, therefore we take away from demand. Let's say we now remove 100 lots. Suddenly, supply is now in favor because we're looking at 1,000 to 900. 1,000 is larger than 900, therefore the market shifts slightly into supply's favor. Okay? Now what we also know is that when we create a swing point and when we enter this region of consolidation, because we know it's a swing high being created, we know that the institutions have executed large sell positions in this region in order to create the reversal and the move lower. Therefore, what's happened is at this region, not only have we mitigated the order, which has caused the removal of X amount of demand, we have also executed more sell positions, which obviously adds more lots to supply side or the selling side. So suddenly, what was 1,000 to 1,000 becomes 1,200 to 900. Or obviously that ratio, that difference could be anything, but let's just take the example of the fact that the mitigation of an order is relevant to us because we are removing demand and introducing supply. Therefore, those processes alone are obviously going to tilt the supply and demand balance into supply's favor. Now, it's worth noting that not every single point of interest or supply and demand zone that we identify within the market is always going to cause a major reversal. Okay, so we can also look inside other regions in the market, such as a buy to sell region that we have here. We see that price did the same thing. We tapped into this. The mitigation of the buy order here removed lots of buying power, so removed demand from the market. The creation of the swing point and reversal is where smart money operators introduce sell positions or execute sell positions, which is adding to selling power in terms of lots, therefore adding to supply. Therefore, we can see that we have had a reversal caused, which caused the move lower. What we would have then done is taken, this is going to be confusing for you guys because I know that I have just said it's a buy to sell region, but if we read the wicks, and I'll go into why, that would be identified as a zone. Bear with me for 1 second. As we see, it's not a buy to sell region in terms of candles. We don't have a buy candle to sells. What is actually happening though is that the wicks represent that what we've had is a move lower and a sharp move back up. Because it's a wick, we know that there's a lot of volume introduced in that region. We know that this region should, on a lower time frame, we can even reference that, still represent a buy to sell region. Okay, now we're on a lower time frame. We can see that in plain day. We can see that in plain sight. We have had a buy to sell region. Now what we can also see, if we go back to the time frame we're on, is price has tapped into that. The mitigation of the zone has removed demand from the market. We've created a swing point. We started to move away because for some time, supply was greater than demand. Supply was in control, but we have not seen a major reversal. Therefore, the point I'm making is the fact that not every single zone affects the supply and demand balance in such a vast enough manner to cause a large or longer term or sustainable reversal in the market. We see in this case, we've had a reaction from the zone because the mitigation of the order has had relevance in terms of shifting or changing the supply and demand balance, but it just wasn't quite enough to cause a longer term move. This is why we have step 3, which is the next episode we'll come on to, which is entry confirmation, because once price taps into a zone, it's a case of how can we determine if the reversal from this zone is looking or is ready to sustain a longer term move lower, or is it going to be a short term reaction like we've seen in this case before a continuation higher. This is why having step 3 in the strategy is very crucial. Also why risk management on top of that is extremely crucial in itself, because not every single zone or point of interest that we identify in the markets is going to be valid and is going to sustain a reversal lower. Of course, the 2 that we managed to identify did sustain large moves lower, but we could go through this entire move identifying more and see that not every single point of interest, every single buy to sell region is going to sustain a move lower. However, the core principle is still the same, where the mitigation of any point of interest has an effect on the supply and demand balance, because as we stated, the removal of a buy order is removing demand from the market, therefore already putting the favor into supply. We then know that if we do create a reversal point and a swing point around that point of interest, that is obviously representing the execution of more sell orders, therefore the introduction of more supply. Now, of course, the only examples we've used here is supply. This is also extremely relevant in terms of demand. And let's see if we can actually look inside of this market or potentially a different market to find examples of this, so I can walk through this example or this concept in terms of demand zones and a bullish market, because of course we've only done so in terms of a bearish market. What I'm also going to do as we gear towards the end of the video, I have now introduced points of interest. Points of interest represent areas in the market where an unmitigated order lays or an institutional footprint. We know that we've had institutional control in this region because the institutions have created a large volume, high volume push up or buy to sell region. We know that it's institutionally controlled because A, we have the move up of high volume, we have the move back down of high volume, we have left a market inefficiency within this region, is an indication of high volume within itself. The other thing that we haven't touched on is that once we created this buy to sell region, once price moves away, we see absolutely no structure returning to that prior, which means that that order is definitely unmitigated. If price was to move away from this zone and then tap back up, that zone would be mitigated, we would no longer be having it highlighted, and it would no longer be relevant. But in this case, we've not seen any valid structure return to it, so therefore we knew it wasn't mitigated, which is why we would have identified it and caught potentially the reversal that happened here in the markets. Okay, so I've simply just gone down to a lower time frame on the same market. If we zoom out, you can see pretty much where we are after that reversal. As price moved down, we have a region of bullishness here that I've just used the replay tool to go back to on a slightly lower time frame. So we can see within this region that we've had clear bullish structure, impulse, correction. That entire move represents an impulse and a correction back down. But what we're seeing is that all these swing low points are being created at a rather relevant point. Structure can be random, but it isn't always. Like I said, try to understand that every single movement in the market's all structure created with the purpose of one man, this one man, or the composite man, is creating everything and doing everything for a reason. So let's try and find reasoning behind it. So we know that we had bearish structure inside of here, where we see that after we broke that low, this high should have been protected. This is clear structural laws. We see that once we blow through that, we then know that we have bullishness potentially confirmed because we have broken a protected high, therefore a very early sign and a good sign that structure that was once bearish is no longer following so because we have liquidated a high. We would have then taken this as our first impulse of bullishness. We then would have looked inside of that impulse and said, where inside of this impulse represents a point of interest or a demand zone? Well, let's look inside of here. Okay, we're following structure. Right, we have something relevant here. Why? Because we have a clear, as the wick indicates, sell to heavy buy. What that means is that we've had a heavy sell where the institutions have opened a position at that level right here to bring price down to this region. And then once we've done that, we have stopped the market, reversed the market, executed buy positions to then push price up with very high volume. And we know that if we look inside of here, we have market inefficiency because there's no structure within this. Now, in order to identify market inefficiency within bullishness, we look for 3 consecutive candles. So we have 1, 2, 3. We take the top wick of the first candle, so that would be the start of our zone, to the bottom wick of the third, which would represent at that point right there. We see that this region in between, all of that is representing market inefficiency, where we know for a fact that there is inefficient market price action and inefficient market structure, which acts as a point of interest because we know that within inefficient structure and an inefficient market, there is many lower time frame orders left over in that region. But back to the point, we would have identified this sell to buy as a demand zone. The reason why it's valid as a demand zone is because of the fact that as we enter this region, there's a sell position here. The mitigation of that sell position removes supply from the market, already tilting the supply and demand balance into demand's favor. And then we know that because we create a reversal and a swing point here, the reversal and creation of the new move higher is where the smart money operators will execute buy positions, therefore introducing more lots of buying power, therefore introducing more demand into the market. So we know as we tap into a sell to buy area, as we know as a demand zone, we are removing supply and introducing demand, therefore tilting and affecting the supply and demand balance into demand's favor. That is why this is a relevant point of interest. Because of those 2 factors, we are removing something and adding another. Whether that is a supply or demand zone, we're either removing supply or demand whilst also actively adding demand or supply. So we've had that happen. We see that after the creation of that, we've had a move higher. It doesn't come to break the high. We've still had a move higher. What we also notice if we follow the wicks is that we've had a sell to buy region down here, or a sell to buy candle. We see that price has tapped into this. We know that this is a good region because we've had a sell to buy. If we use the wicks, we know that what the wicks represent is from the top wick here, we've had a sell down to the bottom of this black wick down there. So that move there is representing a large sell into a high volume buy, where we can also find market inefficiency in between. So we know that there's institutional control there and there should be an order that remains. We see that price then enters this region. Obviously, the tap and mitigation of that order is removing supply. The reversal is introducing demand, hence why this was a valid demand zone. Now, what we are going to notice here is that price then comes back down, but arguably doesn't tap into the original or the first sell to buy region, because this region here represents the first sell to buy region. This is where we need to go through the process of identifying and refining POIs correctly, which may require the use of a lower time frame because there is no clear sell to buy region in here. I'm at a position where I can use the wicks, where I understand that when we have wicks like this or a large wick up, but then the candle closes here, what that does represent is a sell to buy region. Okay, so that is still representing a demand zone, because if we go to a lower time frame, we should now be able to see quite clearly. Yes, now we can see we have clear candle in this region of a heavy volume sell to a high volume buy. Same again in this region, heavy volume sell to a high volume buy. If we were to identify this candle, this clear sell to buy candle, we see that now it's clear why the market has reversed where it has, because on this time frame as we've gone lower, we knew that the wicks represented a heavy sell to buy region. So we also probably would have also identified this one down here, because this is still a valid sell to buy region. And now you're seeing how and why we need that third step of entry confirmation, because within a single impulse, within a single move where we're looking to identify points of interest, there's not always going to be just one. There's not always going to be one that we can say, right, this is the one price we'll reverse from, therefore we know we can take a position from there. If we were to actually look inside of this move, we know we also have a sell to buy candle there, or a sell to buy region. So technically, as price was moving lower, there was 3 possible demand zones it could have reacted to. Obviously, it has to react to one, if any. It cannot react to multiple before making the move higher. So this is why we need entry confirmation, because there's multiple zones that we can identify, multiple zones that could be valid. So make sure that rather than just sticking on one time frame, we are using a multitude of time frames to correctly identify and validate our points of interest. What I also mean by validate is making sure that when we go to the lower time frame, it still represents a sell to buy region where we have a large sell to a high volume buy, which is the case in each of these examples. Okay, so that is now the example of that on the bullish side. So seeing and representing demand zones. What I said I now wanted to dive into is the implication that all of this has within our creating a bias, creating a story, and how we implement this within a top-down analysis. So if you remember episode 2, you'll remember quite well how we perform a top-down analysis. So we start on the highest time frame. We see that now we had a downtrend, period of consolidation, uptrend, the reversal, creation of a new downtrend. Now, the reason why we know that this is the creation of a new downtrend is because we've had the reversal from a point of interest. As price moved lower, we would have identified all of the buy to sell regions as supply zones. So each one of these regions would have acted as supply as price moved down. We see that this one here did have a reaction, but after the reaction and move lower, we could not sustain bearishness any longer. What we needed to do was come and liquidate some of this liquidity on the upside, or the liquidity highs, and come to mitigate an order higher. Because even if we blow through a zone, so for example, we would have mitigated that zone out from that move, but what we did do is down here, if you remember correctly, there was a zone that we left open. If we blow through a zone, we have still removed the buy position. Even if we don't have a reversal from it, we have still removed the buy position, which means that we have removed a key factor within demand. But if that is not enough, we may decide to then target a higher zone to remove even more demand, to therefore flip the supply and demand balance even more heavily into supply's favor. So what we've done here is we've mitigated that major zone, and then we've come to mitigate this major zone. The smart money operators have seen that the mitigation of both of these has been enough to cause the move lower, where we've then seen the reversal. And then technically, if we look at this bullish structure, we've had impulse, correction, impulse. We've had the reversal from the zone, and then we've then come as well to break structure within bullishness, which is therefore a sign of bearishness, therefore a sign of this being a longer term downtrend or impulsive wave, which we know should then come to target this low in order to continue bearishness. Because even though we can see this as downtrend, consolidation, uptrend, consolidation, start of new downtrend, we can also view it as impulse, correction, start of new impulse, which we know in order to continue bearishness, we need to break the low and protect the high. We've obviously protected the high because we believe we are reversing longer term at this point in the market. So what we do is we identify the most recent finished impulse. So we would have identified this as our impulse on the 3-month time frame. If we just draw that on, we've seen that after we've identified the impulse, we then identified points of interest or supply zones. We've then seen the reversal from a zone. So what we do is we take this as a new trend. We go down to a lower time frame so we can see this trend within a better light, and then we can see we've had clear bearish structure within this downtrend that's been created since the reversal. So we've had impulse, correction, impulse, correction, impulse, correction, impulse. So if we identify the most recent impulse that has been created, the reason why we would not identify this is because the impulse has not finished being created yet, because we've still not broken the low. So this is now our 1 month impulsive wave. We then would have looked anywhere inside of that for buy to sell region. We know that inside of here we've had a buy to sell. So that represents a supply zone. Price has tapped into that. Obviously we've mitigated the order that has caused enough of a shift within the supply and demand balance to put it into supply's favor for the reversal and move lower to happen. We then go lower and say, right, well, this bearishness is representing a downtrend. Where's the most recent move in that downtrend? We see this as an impulsive wave. We take that impulsive wave on the 1 week time frame. We then look inside of that for any points of interest, which, as I said, don't be afraid to use a range of time frames to identify them. I can't see anything valid on the 1 week. So let's go down to the 1 day time frame and look inside of here. Okay, this is where we could say that we have a clear, evident by the wicks, buy to sell at that region right there. We also would have identified this buy to sell as we use the wicks in that region. Obviously, we know price is now blown through, but we have mitigated the buy order in that region. So our bias is that on this time frame, price should mitigate this order before reversing, making the move lower. What we would then do is we understand that we've had downtrend, consolidation, uptrend. We're currently within an uptrend. So let's go to a time frame where we can view that uptrend. Okay, we're now viewing the uptrend. Where's the most recent impulse or move within that uptrend? Okay, we've had impulse correction. We're currently within the creation of this impulse, where we're potentially coming back down, but let's just identify that. The reason why we can make this assumption is because we've already surpassed the previous high. We look inside of this as a bullish impulse. We could then look inside of here for anything that would represent a demand zone. So we have a clear sell to buy there with heavy inefficiency after the fact. So that is obviously going to represent a clear demand zone. Looking inside of here, okay, well, potentially this region, let's just view further into that. Okay, we have a clear sell to buy at this region, and we see no structure returns to it. The reason why I've not been identifying really any of these is because the sell to buy regions that are being created, we see prices tapped into them already. If we go to a lower time frame, potentially the half an hour, we can then potentially look inside of this further. Okay, now we can see a clear sell to buy with market inefficiency afterwards, so therefore a clear demand zone. This one here still looks valid, but now we see that we've already had a tap of that zone where that wick's come in, so that one's already been mitigated. We can still leave it on though as relevant. This also ties into the refinement process of zones, where we see that on a 1 hour time frame, the overall sell to buy in this region would have actually represented the overall sell to buy here. We know, however, that on this time frame it's been mitigated. But if we then go lower, as we did on the half an hour, we see that inside of this overall sell to buy, we do have a lower time frame, or a more fractalized or a more refined region that definitely represents an unmitigated order, because there's still a very clear sell to buy, the buy representing market inefficiency, no structure that returns to that region. So that is a process of refinement. And then currently within our bias, we know that these are 4 hour demand zones. So let's just do a recap of what our bias is telling us. Okay, so let's go back to the 3 month and say we know that we should be bearish in terms of the 3 month, because we've had the creation of a 3 month impulse, we've had the correction wave come back up, the reversal from a point of interest, which is a good enough sign, alongside the break of structure to the downside, that this is the new impulsive wave. Well, let's look inside of the bearishness of this impulsive wave to try and find positions to trade price down to the final target where we believe price will end up, or is most likely to end up, which is where we then go to the monthly time frame, identify the most recent move within this overall downtrend. So identify the most recent impulse within the trend, identify the point of interest. We see prices tapped into, reverse from that point of interest. We've also then, in terms of bullishness, broken a protected low, therefore delivering a break of structure. Therefore, we know This is now the creation of a new downtrend. Okay, well, let's look inside of that downtrend. We've taken the most recent impulse inside of that trend. We've then gone low enough to identify a point of interest inside of this impulse, which we want price to trade up to before seeing a reversal move lower. Okay, well, in order for price to get up to that supply zone, we must continue trading bullish. If we get delivered a correctional wave before the tap of this zone, we would expect that this correctional wave has the purpose of tapping one of the two demand zones before mitigating the order, having enough demand introduced in the market to cause the reversal, push higher into this zone, where we'd then see the removal of the buy orders in here and the introduction of supply. If when we tap this zone, the mitigation introduces enough supply, we'd then expect the reversal and to see price then move lower. But if price then breaks through this zone and we don't have enough supply introduced from the mitigation and we start to come higher, we break 1 week structure. We then return to 1 month structure and say, right, well, if we break outside of that region, we know that within this downtrend, the downtrend's coming to an end, which means what? Okay, well, that means that price is going to come back up. It's either going to invalidate monthly structure and make a move higher, but we also know that through the process of orders and order mitigation, we say, well, let's look inside of here for any orders that may remain. So we've recently had a mitigation of that. It's a supply zone. But I would argue that somewhere inside of here, that wick represents a buy to sell. So if we do invalidate 1 week structure, it could simply be for the purpose of trading high enough to mitigate this zone, which should then reintroduce enough supply in the market to then cause a new move lower. Because of course this can be seen as a single downtrend, but if we have the break of 1 week structure, this then ends up becoming downtrend, consolidation, uptrend, consolidation, downtrend. We are still creating bearishness from this zone as we head towards the target. We've just done so in a slightly different and less aggressive manner. But getting back to our bias, obviously this is how we perform at top down. We slowly work our way down, finding points of interest, identifying the most recent impulsive waves, and creating a story. So everything I've just walked you through in the last, 10 minutes of going through my top down analysis, every single word within the last 10 minutes is representing information within my bias and within my story. So just a recap on that, we want to see price tap this supply zone and move lower to fulfill bearish structure. But in order to do that, maybe we see a correctional wave into one of these zones to introduce enough demand to make that move higher. When we reach this zone, or this 1 week supply zone, we can even draw that on, we're hoping to see the mitigation of that order introduce enough supply to cause a reversal and move lower and continuation of this downtrend. If we break that, we know that, okay, we could actually now just be reversing and mitigating this order that has been left over in the markets. If not, and we blow through that order, okay, well, there's no more orders higher for us to go. So it's then very likely that we are coming to invalidate this move and start making a move higher. If we then make a move higher, well, is there any orders left over in this region that need mitigating? Well, yes, because we have a clear buy to sell in that region, as well as multiple buy to sells in this region, which we should be able to quite clearly identify. Okay, so we can see that if price was to then break these highs and invalidate that structure, there is still points of interest above price that it could target. So this is all the story. As confusing as it may seem, all it is now is an extra layer in our top down, where as we go lower, rather than just identifying the most recent impulsive wave, we're also taking that a step further to start identifying all points of interest and all unmitigated orders. It is worth noting, I know I've just randomly started throwing a few supply zones on, we wouldn't actually have to do that until we saw the invalidation. When I drew this zone, I wouldn't actually need to do that until the 1 week structure there was invalidated, and then be like, right, well, let's see if there's any zones higher that price wants to mitigate. I would also not need to identify these zones until this 1 month structure was invalidated, and we thought, right, well, let's see if there's anywhere price wants to go. Because remember, price doesn't have to follow this impulsive wave in order to remain bearish in this region, or in order for this to still be an impulsive wave. We can quite easily still see a move higher. As long as price protects that high, it can trail back up anywhere below that high before making a move lower, and that would still be classed as valid structure, and this being a valid impulsive wave. There's a clear example of that happening in this region where we've had the reversal, creation of bearish structure, where we had impulse, correction, impulse, This should have been protected. A move comes through to break that protected high, which doesn't invalidate the overall bearishness. We've just liquidated and broken that protected high with the purpose of mitigating an order that laid above it. So until we fully break the higher time frame high, structure is still confirmed. So we can still see these intermediary breaks and liquidations of highs and lows without it meaning a long-term trend reversal. Of course, we could continue doing this an infinite number of times, going even lower again now to like the 15-minute, identifying the fact that, okay, this is arguably the most recent impulsive wave. We have a sell to buy region in there that price has just tapped into. Are we going to have a move higher, so on and so forth? Now, I don't think we need to add even more layers to this top down, as that is something you can do within your own analysis. I think we've got the point across there of how we implement points of interest within our top down analysis, or how our top down analysis now uses steps 1 and 2, how we can now find exact points in the market of reversal. So for example here, rather than us saying, right, well, we're delivering a correctional wave, all we know is that price has to reverse below the protected high and eventually meet the final target in the market. Well, no, we know that, okay, we've identified a clear region in the market, a clear point of interest, a clear supply zone. So we know that price should tap into this region. It should reverse from this exact precise region. Therefore, in us doing that, we can now execute positions which are much more refined because we have an extra layer to that analysis, therefore delivering extra confirmation. So hopefully all that's made sense. Of course, any questions about anything in this video, make sure to leave a comment or message me directly on Telegram at James LAGFX. I will always be open to questions. I will always be happy to answer those and explain these things in further detail, or just try and help you get your head wrapped around it. I know it's a lot of information to take on. I know it can be rather confusing, but just now go into the markets, apply step 2 into your analysis, and slowly things will begin to click, become muscle memory, become second nature, and it will all begin to make perfect sense. So I hope you've all enjoyed this. I hope now this is added more layers so you're much more comfortable within the smart money concept strategy, much more comfortable applying this within your analysis. But as we move on now, the next episode is going to start this third step, which is entry confirmation. So we've gone through step 1, which is market structure and creating a buyer/story. We've now just finished step 2, which is points of interest and supply and demand in the market. And then step 3 goes into Wyckoff schematics and entry confirmation. So the next 2 episodes are going to go over everything there is to know about Richard DeMille Wyckoff and how we use him and his concepts and his schematics as entry confirmation to confirm a valid entry and refine our entries in the market. So I hope you enjoyed this episode. I hope you're enjoying this series so far. Make sure to smash the like button if you have. If we get enough likes, I will consider adding even more episodes to the end of this to show further implications, to show more concepts within the strategy, and give much more information. So thank you everyone for watching, and we'll see you next week in the next episode of Learn to Trade Smart Money Concepts.